Well, when it comes to net earnings from self-employment regulations, they provide that trade or business activity must be carried on by an individual. Joining us now to review self-employment tax on farming activity of trust is Kansas Farm Bureau Professor of Agricultural Law and Taxation at the Washburn University School of Law, Roger McEowen. Thanks so much for joining us, Roger. And let's start with the basics, and then we'll dig into the details. Can you give us an overview of what a trust is?
Yeah, good morning, Christina. This is a big issue for farmers. Of course, self-employment tax in general is a big issue for farmers and ranchers all over the country. But a trust is not subject to self-employment tax on its earnings. So if we really have a trust that's operating a farming or ranching business, then there's no self-employment tax on that business activity, as there would be if it was operated by an individual. So basically what the IRS looks at is whether a trust was created for the benefit of beneficiaries to conserve property for them, or whether it was just a device an entity to pass earnings through that could have been operated as a partnership or a corporation. So if it really is created for beneficiaries and to conserve property for them, then it'll be a trust, and there'll be self-employment tax savings if the farming operation is run through a trust like that.
Okay, now let me see if I understand this correctly. The regulations provide that a trade or business must be carried on by an individual, either personally, through agents, or employees. Can you unpack how this affects income derived from a business maintained by a trust?
Yeah, that's the big key. If we, for example, create an estate plan where property passes to a surviving spouse in trust for life and then down to the beneficiaries, and that's a farming operation or a ranching operation that is passed on to the surviving spouse in trust, the earnings from that business run through the trust like that, since that is created to conserve property for that surviving spouse. Those earnings will not be subject to self-employment tax. And of course, that's the 15.3% tax that we're talking about. But if the property is left outright to the surviving spouse and he or she runs the farm as an individual, they'll have to pay self-employment tax on those earnings because they're materially participating in operating the farm. So it's a nice break from self-employment tax for a business activity that is run through a legitimate trust, and legitimate trust for estate planning reasons will get you there.
Okay, now what type of a situation would serve as a basis for disregarding the entity?
Well, if IRS can't find that there was a legitimate reason for creating the trust to conserve property for a beneficiary, then they're going to get upset about that. And they're going to be interested in attaching self-employment tax to that, because they'll take the position that that's just a business entity or an individual that's running the business.
Okay, more priceless wisdom. Thank you so much. Kansas Farm Bureau Professor of Agricultural Law and Taxation at the Washburn University School of Law, Roger McEowen. We really appreciate your time and what you teach us each and every week.